The mega caps are at it again. They led the rally today, but not without the broader market. Yields fell, the dollar fell, and everything rallied, with the Russell 2000 outperforming. But there certainly are risks to this market right now. PPI came in very hot, and we need to talk about what happens in an environment where consumer prices are falling, but producer prices are increasing. What dynamics come as a result? How does it affect markets? And is this an early warning sign of something more sinister occurring under the hood? Today, we're going to talk about that, sentiment, rate cut expectations, as well as the best small cap stocks to own for the next 3 to 6 months. If you want alpha, you're getting it today. We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. It really helps me out. Let's get into it. Another green day for the S&P 500 and another broad day, broad-based buying across the board. And we actually saw quite a bit of participation in the mega caps. We saw green here in Apple, Nvidia, Tesla, some of the bigger healthcare names, Eli Lilly, United Health as well. So the big names were green, but some of the mega caps didn't perform well today. Looking at stuff like Microsoft, Amazon, Google, and Meta, which meant comm services was the worst performing sector in the S&P 500. But we also saw quite a bit of red here in banks in the context of financials being in the green. It had to do with earnings. JP Morgan, Wells Fargo, and Citi all reported earnings, and we're going to talk about what happened there. But diving into more specific sector analysis, you can see some very interesting trade right here, very up and down. We had a very strong early morning rally in all stocks. Then we actually saw the market par those gains into midday. Then we had like a midday into end of day rally, and then we had a weekend risk off pullback, and that was sort of the ebbs and flows today, with the S&P 500 returning 0.63%. Now we did see outperformance in some of the mega cap names, but it was still largely rate sensitive and commodity names that were up there as well. Now the best performing sector was ITB, home construction, home builders. Then we also saw real estate outperform the SPY. And then we had some of the commodity sensitive names, XLB Materials, XME Metals, sprinkled with some of the mega caps, some of the software names, some of the tech names. Look at the XLK, semiconductors, as well as the discretionary space. So it was a mixed bag of defensive stocks rallying today, rate sensitive, cyclical, growth, financials. It was really just an everything rally except in XLC. Communication services didn't quite get the love we expect, and there's a reason for that. They actually look like the most unattractive sector heading into this earnings season. We talk about it a little bit later in the video, so stay tuned when we talk about earnings for next week. Now, stocks that underperformed the SPY were still green today, with GDX, KRE, regional banks, energy, financial, staples, industrials, and health. Very solid gains across the board. Gold miners was actually kind of crazy because they were up 5% yesterday, and to see up another 0.21% is actually kind of insane. I think that might be the best performing sector there for the week. But it wasn't all good news here today. The market actually just brushed off a lot of bad data that we got. Now, we got PPI month over month, as well as the core PPI figures, and it actually came in a lot hotter than expected. Look at the headline figures, right? Month over month, year over year. Consensus was 0.1, 2.3%. We got 0.2, and then the year over year figure came in at 2.6%. This is literally inflation that businesses are dealing with. Look at the core figure, right? Consensus 0.2 month over month, 2.5% year over year. We came in at 0.4, nearly double the consensus expectation, and then 3% for the year over year figure. And when you have lower consumer prices, higher producer prices, what you're going to see in businesses is margins getting squeezed. So that's what we really have to pay attention to this earnings season, to understand if this is a supply issue, a business specific issue, an economy issue, or a consumer issue. And if it is a consumer health issue, that's going to have major impacts on growth looking forward, and then we may actually need to adjust our forecasts for the rest of the year. But as it is right now, the market brushed it off. I'm going to do a deeper dive into what this dynamic means in the weekend video, so go ahead, subscribe so you don't miss that weekend video. So earnings and margins in particular are going to be in big focus this upcoming earnings season, and we actually had a couple of the bigger banks report earnings here today. JP Morgan, Wells Fargo, Citi, BNY Mellon, Fastenal. Now, Fastenal is an industrial stock. They reported great earnings. They were up 5%. In fact, I think it wasn't great. It was in line, a slight raise of guidance. But the market really did like their earnings. BNY Mellon too reported great earnings. In fact, all of these banks reported very solid earnings in my humble opinion. However, the bigger banks, JP Morgan, Wells Fargo, and Citi, all got sold off. BNY Mellon got bought. And I think that goes to the broadening out dynamic we're seeing in the broader market, with tech and the rest of the sectors. I think we might see something very, very similar here in financials, because JP Morgan actually reported great earnings. They were down. Look, they beat on EPS, beat on sales. Banking and payments revenue was up 9%. Investment banking revenue was up 46%. The stock was down 1.17%. Nonetheless, I do think JP Morgan will probably get back to all-time highs. These were good earnings. These were very, very good earnings. Key metrics were up. Guidance kept the same. There was nothing bad in all of the earnings. Citigroups and Wells Fargo. Wells Fargo's there was a bit of an issue with the interest income. That's why it got sold off significantly. But I think the market's going to look past that in a couple of weeks. But let's dive into the S&P 500. Now, the S&P 500 gained 0.5%, up 0.55% here today. Nasdaq 100 gained 0.59%. IWM was the outperformer, up 1.17%. We're going to talk about the IWM a little later on in the weekend video, particularly as we see the IWM here approaching overbought conditions. What does that mean for the IWM? So go ahead, subscribe so you don't miss it. The equal weight, the RSP, up 0.88% and actually breaking above some key levels you can see here in the RSP and less than 0.5% away from new all-time highs. So much can change in just a week. Kind of crazy. No one wanted RSP right here. Everybody wants RSP up here. Mid caps were roughly up the same, and profitable small caps, SP 600 up 0.9% and not quite as overbought as the IWM. Now, growth and value actually performed equally here today, and yields did actually fall, and that's part of the reason why we actually saw continued up movement in some of these smaller names. The 10-year yield was down 0.64%, and that bid bonds up. The TLT gained 0.43%. Looks like it's having trouble here at this $93 level. But what it really needs to do is break above this $94.68 level, use it as support, and then move higher. If it can't break above here, it's probably going to likely find resistance, and then we're going to move lower and see maybe yields spike up. Do I favor that? No, I don't. I think we're going to break through this level and move higher, especially with rate cuts on the horizon. Gold was relatively flat, down 0.19% today. Silver took it on the chin, down 2.12%. Crude fell, but quite a bit of volatility, as you can see right here. And it's looking like this $85 area is the resistance area. We'll see what the next move is. I do favor a move down to this $80 area next week. Now, let's dive into the S&P 500. Now, we are going to start on the weekly chart. Now, the weekly chart for the S&P 500 looking very bullish. You can actually see that if we actually zoom out, look at the last 5 or so years, we are in an uptrend here in the S&P 500 in the weekly chart. This dip we saw in 2022, this correction in time, as well as a bit of a pullback from the highs, was a great buying opportunity. The S&P 500 from the lows to where we are right now on a peak to trough basis, up 62% in about 19 months. Very, very bullish. And if you actually look at it since the start of 2023 right here, we've had a very, very strong run, making higher highs, new all-time highs, as well as making higher lows on the way up. This looks bullish. You can't tell me otherwise. And a lot of the price action we're seeing right here in the S&P 500 is actually being backed up by earnings. We recently saw that with some of the bigger banks, as well as most of the S&P 500 stocks in Q1. Now, on the weekly chart, very, very bullish, and we do have some key levels that we can look at. The very first key level on the weekly chart is 52.71, and then the next key level is this level right here, which was the previous all-time highs for the S&P 500. Pretty much, if we are to, let's say, get a pullback in the S&P 500, these are two key levels on the weekly chart I would be looking at as great dip buying opportunities. The first one right here, the second one at the 47.55 level. I would also say at the psychological 5,000 level right there, that would probably be another level I would look to. So a lot of downside support if we are to pull back, and we would still remain in an uptrend, a very clear uptrend if we are to pull back to these levels. It gets a bit dicey below the 4,700 area, but we are a while from there, and the S&P 500 will need to pull back like 15% to get to that level. And I just don't see a meltdown of that magnitude occurring in the here and now in the S&P 500. I think we could definitely pull back, have a 5%, maybe even a 10% correction, but I do think all those dips will get bought. But let's dive into the daily chart, and we can see similar to the weekly chart, things are looking very, very strong. Now, Friday's candle looking a bit sus, I guess. Green candle for sure, was a green day. A lot of that predicated on a gap up, and yes, we did get a lot of selling here at the top on Friday. But if we dive into the 5-minute chart, we can see some very, very clear price action. We got a gap up, right? And then we had a huge rally. We made a high, higher low. Then we actually made a higher high, broke the high we made yesterday. But then we actually did pull back, making a lower low, but still closing above the close yesterday. I would say that this right here is a bunch of factors. Number one, it's a bit of risk off into the weekend after the stellar rally we've had this week in the S&P 500. I mean, for the week, the S&P 500 is up 0.86%. And that is in the context of some of the mega caps getting sold off viciously on Wednesday and Thursday. So we saw a little bit of risk off here in the S&P 500, still green for the week, green for the day. However, that was a new all-time wick high, not a closing high. And so what are the expectations for next week? Now, the very first thing I want to look to is the gamma chart. Now, 5,600 is still the core resistance, as you can see right there, and 5,300 is the put support. However, the gamma flip zone is moving higher. It went from 5,500 at the start of the week to the 55.45. That's a big move, and we are seeing a little bit of volatility compression into this July OPEX. In other words, the call gamma resistance staying where it is and the gamma flip zone moving higher. And we could see that the 5650, 5700, 5750 and 5800 strikes are getting built out quite quickly, but it does look like we are probably going to get a move up to the 5700 sometime next week, especially if we go ahead and close at the all-time high. So when it comes to the S&P 500, 55.45 on the daily chart next week, that is the level I want you guys to look at. Let's just go ahead, mark it out, 55.45 right there. Okay, so next week in the S&P 500, if we pull back, we should find support right here and continue to move higher, especially if mega caps continue the stability we saw today. But if we are to break the 55.40 area, I think we could probably look to as low as the 5,000 area as the first line of support, and then this level right here, 54.40. If we do break below these levels in the S&P 500, things will get a bit dicey. Then we could probably look to our weekly levels. Now, there's not a lot of macro data next week. I think we just have retail sales, pretty much it. So a fairly light week of macro data. And generally speaking, the S&P 500 does tend to drift higher in weeks where the macro data is uneventful. So I'm looking to buy dips at 55.45, below 55.45, 48.50. Those are the two levels I'm looking. Below 48.50, we can actually see significant downside to the 52.71 area. Could it happen? I don't really think so with the breadth dynamics we're seeing when we're seeing a rally in the RSP, the IWM, the Nasdaq 100. I think what we're really going to see is mega caps trade sideways, the broader market rally, and that's probably going to make the S&P 500 step higher. And if we do get dips to these areas, you want to be buyers of these dips. We are going higher. We're seeing a broadening out, a broad-based rally. If we actually look at the advanced decline line, very, very strong. This is signaling to us that this rally is broad-based, an all-time high in the advanced decline line, all-time highs here in the S&P 500. You don't want to fight the trend. We are going to move higher with this broad-based action. We could see 58, 5900 in the S&P 500 over the next couple of months. So buy the dip, don't trip. And finally, along with S&P 500 hitting new all-time highs, we finally have the fear and greed index in the greed zone. And we know why this is. 2 out of the 7 components that make up this indicator are breadth and strength momentum indicators. So with improving breadth and market strength, we can actually see this push into the greed zone. We always knew it was going to happen. We always knew that market breadth was going to broaden out. We are starting to see it. And according to the fear and greed index, there is still room and gas left in the tank. I do expect this to continue to move into the greed zone regardless of what the mega caps do, whether they're down next week, flat next week, or up next week. I think if the market broadening out continues, we will move further into the greed zone and maybe, just maybe, get into the extreme greed zone where we can potentially see some pretty good opportunities to maybe even get short and or hedge our portfolio. That's something we haven't really had to do in the last 18 months. There hasn't just been that type of volatility to actually go ahead and hedge your portfolio. And maybe, just maybe, with the market breadth momentum we're seeing, we can get into this extreme greed zone, and then I can show you guys how to properly hedge your portfolio for downside risk and volatility expansion. Now, with the first week of Q2 earnings done and dusted, some of the bigger banks, Pepsi, we'll call it mixed results. Where can we actually find value, and what are some ways to play earnings? Now, BofA got some great data right here. It's just sector ranks for the second quarter earnings. Industrials, financials, and tech rank best. Com services and materials rank the worst. Now, this is based on an average ranking of EPS and sales revisions ratios, guidance ratios, and last quarter earnings surprise results. They tally them all up, rank them according to attractiveness, and they find that industrials, financials, and infotech are the most attractive and pretty much much how this chart works is if the number's above 1, more management teams are guiding earnings up, or analysts are guiding earnings higher than analysts guiding earnings lower. Likewise for sales, management teams here for guidance ratios, and then earnings surprise beats versus misses. The most attractive, industrials, 2.86% surprise ratio, 1.29% sales, 1.06 estimate revision, and 0.92 guidance ratio. This compares to the worst sector, comm services, which saw a guidance ratio which they don't even list, an estimate and sales revision ratio of 0.96, 0.47, that is kind of shocking, and then a surprise ratio of 0.93. And yes, even though Meta and Google are a part of the sector, there's a bunch of other stocks in it, a bunch of telecoms, a bunch of entertainment stocks that don't fare so well. And when it comes to Q2 earnings here in 2024, if you want to play sectors, look at industrials, financials, technology, or maybe individual stocks in those names. And if you're looking to downside plays, maybe stuff in comm services, excluding Meta, Google, materials, and utilities. Now, looking at Russell 2000 blended earnings growth rate for the second quarter 2024, I know it says first quarter, but this is second quarter earnings, guys. I just made a bit of a typo when I wrote this up. However, earnings are looking very, very dicey. Now, the first things first, you look at this figure right here and you go, whoa, 18.4% earnings growth for the Russell in the second quarter. That looks great. Firstly, number one, only 28 companies have reported. This is blended earnings growth, so they take the estimates of the remaining 1,970 whatever to form this number. Now, X Energy are looking at 28.4%, but on the revenue side, it's not looking quite as bullish. So we're seeing a lot of operating leverage being baked into earnings for the Russell 2000. We'll see if that materializes. Secondly, when you actually do a deep dive into the individual sectors here, you can see that the entire Russell Ponzi, the earnings has been held up by real estate and healthcare. These two sectors right here are seeing earnings growth of 45.1% and 43.8%, right? In other words, over-leveraged small office REITs, regional retail REITs, and healthcare REITs and biotechs is producing the majority of the earnings. We see a small tad in earnings in discretionary as well as utilities. Other than that, we're seeing earnings decline across the board from financials or regional banks, staples, industrials, tech, energy, materials, comm services. Here on the earnings side, it's a bit more mixed on the revenue front, which shows that a lot of these small caps are still struggling with pricing power. Look at stuff like comm services, 3.3% revenue growth, negative 108% here on the earnings side. Look at something like financials, right? 4.9% on the top line, and then when you go to earnings, negative 5.1%. So, and this is telling us that a lot of these stocks that see increased revenue but decreased earnings, struggling with maybe inflation pressures, wage pressures, pricing power. In stuff like financials, you have a ton of regional banks. They're probably dealing with a lot of loan losses in the office space, the retail space, but still seeing growth in the top line just due to the simple fact that prices are higher than what they were a year ago. So very mixed earnings for the Russell on the revenue side. It looks really good if you just look at the figure alone, but the devil is in the details, and we really have to see how this pans out, because if real estate goes belly up or healthcare, biotechs go belly up, they have massive misses or the earning surprises don't come in line, we could actually see this get revised down in a very big way. So we're going to keep a very strong track of Russell 2000 earnings. I think especially with the rally we're seeing, especially with the movement we're seeing in the last couple of days, we need to pay close attention to Russell earnings, because the market right now is pricing in a lot of these earnings. But let's assume those earnings are true. Then small cap equity risk premium looks actually pretty attractive. It's at its historical average, which means looking at this valuation metrics, the market isn't overly pessimistic or overly optimistic on small caps, but generally speaking, the relative multiples suggest that small caps could outperform large caps over the next 10 years. And based on a PE of 14.68, that suggests Russell 2000 can see 10% annualized 10-year returns, which is about the S&P 500's average over the last 50 years. And in fact, you could actually get small cap quality ETFs that trade at like 15 times, 15.5 times, some even 14 times. Look at tickers like XSHQ, stuff like CARF, stuff like QSML. This one trades right here on 15.8 forward. SXHQ trades at 14.4 forward. And I think you could actually get like outsized returns in these relative to the Russell 2000. That being said, I think small caps still look relatively attractive if you've got a very long time horizon. But let's say you don't want to invest in the IWM. What are some individual names in the small cap space that you could look to that are likely to perform exceptionally well over the next 3 to 6 months? The first one I would look to is a REIT, Peakstone Realty Trust. It's an office REIT. I think office has been a bit of a dumpster fire. We all know why. It has to do with COVID, but I do think they're going to be on the up and up. And if we do get rate cuts and we do see improvement in the macro, their cap rates improve significantly, particularly if we get 150 basis points worth of rate cuts over the next 2 to 3 years. We could see the stock go from $12 where it is right now to $25, $26. Also, this stock right here pays an 8% dividend. So if you're looking for yield in your portfolio at an attractive price, this is definitely a name you want to look at. Another one is Install Building Products. Now, not tied to REITs specifically, but it does install products for new construction homes. I think with the rate cuts and some of the tailwinds we're seeing in immigration, I think a stock like this should outperform. These are all-time highs. I think in this rally, we probably go back to those all-time highs, 270. Good for a good trade. I think it'll do very, very well. Another one is Paycom Software. Similar to the immigration trend, Goldman Sachs actually see the unemployment rate falling from the 4.1% level where it is right now to 3.8% at the end of 2024. Paycom Software should benefit as well. It's a small cap. I would say closer to a mid cap actually. And I think if you are to look at a diversified portfolio of small caps, getting a software name that's tied to the macro that'll also benefit from rate cuts is great. This is also a small cap with zero debt, great balance sheet, great management, great product, taking market share from the big players, 98% recurring revenue. I actually own the stock. I like the stock. I think it'll outperform. And I think, this thing is trading at a 16 times PE for 98% revenue, taking market share from ADP. I think the market's going to see a massive repricing in this really, really soon. Should do really, really well. And the last one is Mueller Industries. This is more tied to steel and copper. I think commodities should do really, really well, particularly copper, but they actually make products from those copper housing products and install it in houses. So you're looking at a commodity trade, rate cut trade, real estate trade here in Mueller Industries. And all of these together, I think should outperform the Russell 2000 over the next 3 to 6 months. So let's talk about the macro. So everything stemmed off the CPI yesterday. CPI came in very, very cool. In fact, we saw month over month deflation in the headline figure right here against the forecast of 0.1. We came in at negative 0.1%, and that put the year over year figure at 3% when the forecast was 3.1%, previously 3.3%. So we saw massive amounts of disinflation on a month over month figure, and we really needed that. This was an important CPI print because growth data has been slowly moving to the downside since the peak we made here in February 2024. Economic data has been soft, growth data has been soft. We actually just see this in like the Fed's GDP now. Here, early May, late April, we were looking at GDP for Q2 sitting at 4%. And as the growth data has come in a lot softer, we're now sitting at about the blue chip consensus of about 1.8. The Fed's GDP now sitting smack bang on 2%. We get GDP data released either next week or the week after. And this is why that CPI print was so pivotal, because if you get weaker growth, flatline, or higher inflation, that's actually stagflation. That's not a good thing, especially with the amount of stimulus we printed, the cost of living crisis we've seen. We definitely don't want that in the current environment. The Fed were treading a fine line, a thin line, and they've managed to tread it carefully. And it does look like we probably are going to get our first cut in September. This is just a little bit note here from Goldman with regards to the CPI report we got yesterday. Let's go ahead and read. They say June core CPI rose 0.06% month over month, 14 basis points below consensus and the slowest pace since January's 2021 winter COVID spike. The composition was not as soft because airfares and lodgings contributed negative 8 basis points to the core figure. However, we believe most of the step down in shelter categories is sustainable, and price increases also slowed for the healthcare services, another relative persistent category. We tentatively expect core PCE prices rose 0.2% in June, in line with our previous assumptions and corresponding to a year-over-year rate of 2.6%. This morning's CPI report supports our view that normalizing the funds rate is becoming reasonable, and we continue to expect the first cut in September. And if we do get a soft landing, the reason why the Fed is cutting is to normalize policy because real rates are too high. If you have a 5% Fed funds rate, right, and a 3% inflation rate, the real cost of your debt is 2%. But if you have disinflation, now you have a 5% Fed funds rate or a 5% interest rate, and then inflation is now at, let's say, 2%, right? The real cost of your debt is now 3%. Even though you have seen disinflation, technically speaking, your debt got more expensive, and the Fed need to either do a couple of things: increase inflation or just decrease the funds rate to 4% to normalize us back to 2%. And that's exactly what Goldman are saying here. We continue to expect the first cut to normalize the Fed funds. And most of the time, when you're cutting in a soft landing environment, you're cutting to normalize policy. And when cuts are done to normalize Fed funds in a non-recession, it's normally very bullish for equities. You could see if when Fed cuts and there's no recession, in our case, a soft landing, the S&P 500 can return anywhere from 10 to 20% 12 months later. But where we do enter a recession and cuts are done to support the economy, equities normally fall 9 to 10% 12 months later.